I saw a chart this week from Bank of America that more or less sums up my entire investment philosophy. In the long run, stock prices go up. I view the stock market as a way to invest in innovation, profits, progress, and people waking up in the morning looking to better their current situation. While I love the fact that this chart illustrates my long-term philosophy, it's a bit misleading. Yes, the stock market goes up over the long run, but it can also get crushed in the short run. That can be difficult to see on a log chart with 200 years of data. The Great Depression, 1987 crash, and Great Financial Crisis look like minor blips on this chart, and while every crash eventually turns into a blip on a long-term chart, they don't feel like it in the moment. You can't look at an up and to the right chart of the stock market without taking into account the drawdowns along the way. The Great Depression was not a blip, it was a tsunami. People thought the 1987 crash was going to lead to a depression. The financial system was teetering on the brink of extinction in 2008. Sometimes the stock market crashes, sometimes it takes years to make your money back. You don't get a long-term chart of stocks that moves up over time without getting your face ripped off on occasion. If you can't survive the short-term drawdowns, you don't get to participate in the long-term gains. This is true for market crashes, run-of-the-mill bear markets, terrible years, and even good years in the stock market. Another favorite chart of mine that helps explain the stock market is by looking at the annual returns matched up with intra-year drawdowns. The average intra-year peak-to-trough drawdown since 1928 was minus 16.4%. Losses in the stock market should be expected. The other takeaway from this chart is that drawdowns happen even when the stock market finishes the year in positive territory. The average intra-year drawdown in years that have finished with a positive return for the S&P 500 going back to 1928 is minus 11.6%. So you should expect to experience downside volatility even when stocks are in an uptrend. In fact, the average drawdown when the S&P 500 has been up by 20% or more during a given year is minus 11%. You've had to live through a double-digit drawdown in roughly half of all 20% plus up years in the stock market over the past 95 years of returns. The other surprising stat here is the sheer amount of 20% plus returns you see in the stock market in a given year. In 34 of the past 95 years, the US stock market has finished the year with gains of 20% or more. That's a greater percentage of years, 36%, than the number of years that finish with a loss, 27%. Thanks for visiting our channel.